Hey everybody, welcome to this week's edition of Drawbridge Finance. Today's topic is really basic. I am going to talk about why to invest in bank stocks rather than invest in their products. Now, I can take a quick look at the CIBC website, just choosing CIBC randomly. It's one of the big Canadian banks, and I'm going to quickly go over to their GIC portfolio. And for those of you who don't know, a GIC is a guaranteed investment certificate. So scrolling down through, we're going to take a look at what the performance is on a guaranteed investment certificate that we would purchase today. So if we put money in, they guarantee that they will pay us X amount of dollars over the time frame that we choose. So you can have different types of GICs that are in varied length. Typically they're like 1, 3, 5 year lengths, and they would have a various rate of return. And the guaranteed ones, it's really simple. You can just look at the list and you can see all of the rates that are posted. And doing a quick perusal through this, I can quickly see that these rates are anywhere between 0 and 1.5. I think the highest one I could find in here was like 1.7%. So what I'm going to look at is whether or not that is a better investment than purchasing the actual stock in CIBC itself. And almost every time, buying the stock wins out over buying some basic product that they sell to their customers. We can quickly take a look at Google Finance. We can pull up the ticker for CIBC, and we can see that the stock dividend yield is currently $1.24 per quarter, which means that for every share that you purchase for $111 on a quarterly basis, so once every 3 months, you will receive $1.24 in cash, which works out to 4.44% annually. These are cash dividends that the company gives to you because you have loaned them your money. So that's the first thing I look at is dividend yield. So if I purchased a share, then the dividend is going to yield more money than a majority of the products that they're trying to sell you. The next thing we need to look at is whether or not that stock price is sustainable. And so I'm going to take a look. I'm going to compare the values of their chart, which is, giving the values of what their rate of return for the 10-year, 5-year, 3-year, 1-year, 6-month terms. And let's take a look at the stock prices of CIBC going back. And we can see that the stock has gained money in the past on every single one of those terms, which means that if 6 months ago, if we had purchased this share, we would have made money on top of the dividend that they're already paying. So not only are you getting the dividend, which is almost equal to the GIC, and more in most cases, but we're actually seeing an increase in our initial investment. So this is like an absolute no-brainer. And the reason that this works is because the banks are businesses. They are financial entities, and their job is creating wealth. So they take their customers' money and they turn that into wealth. So when you purchase shares in the company rather than buying the products, you are actually becoming a shareholder. And their shareholders get to split a portion of the wealth that they're generating as a business. So we can check these all day long, all the banks, they all work the same, insurance companies. I recently this week, I looked at Sun Life Financial, I looked at Great West Life, and I looked at CIBC. And all three of these, in all instances, over each term that I looked at, purchasing the share would have resulted in more money than investing in the product that they offer. So the next time you think, I've got a little bit of cash, I'm going to go to the bank and I'm going to buy some GICs and this is going to make me a 1% return, do yourself a favor, purchase the stocks, collect your dividend, and watch the stock value grow. You will always, always, always make more money. That's this week's tip. Thanks so much for watching. See you soon.